What I am about to show you is the proof that they do not want you to see. Right now, silver is trading around $86 per ounce. Just 5 weeks ago, it hit an all-time high of $121.67. Then it crashed 35% in a single day. The worst silver crash in 44 years. Most people blame the market. They blamed volatility. They blamed speculators getting what they deserved. But here is what they did not tell you. From at least 2008 through 2016, JP Morgan, through numerous traders on its precious metals and treasuries trading desks, including the heads of both desks, placed hundreds of thousands of orders to buy or sell certain gold, silver, platinum, palladium, treasury note, and treasury bond futures contracts with the intent to cancel those orders prior to execution. That is not a conspiracy theory. That is directly from the CFTC, the Commodity Futures Trading Commission, the official government regulator. JP Morgan is required to pay a total of $920.2 million, the largest amount of monetary relief ever imposed by the CFTC. The order finds that JPM's illegal trading significantly benefited JP Morgan and harmed other market participants. $920 million in fines, the largest penalty in CFTC history. And that same bank, they are still the primary custodian of SLV and one of the biggest players in the silver market today. If you own silver, you need to see what I am about to show you. If you think markets are fair, I am about to change your mind. I have the screenshots. I have the data. And by the end of this video, you will understand exactly how they crash silver. Welcome to AG Profit Hub. This is where we expose what is really happening in precious metals markets, while everyone else feeds you the official narrative. Subscribe right now and hit that notification bell because this is the kind of investigation that mainstream media refuses to do. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see the truth. And trust me, this evidence could change how you invest forever. Let me start with the documented criminal history because this is not speculation. This is public record. 8 major banks systematically manipulated precious metals markets during 2008 to 2016. Regulatory fines, $1.27 billion across 8 banks. Criminal convictions. 2 JP Morgan traders served federal prison time for spoofing. Let me break down exactly who paid fines and how much. JP Morgan, $920 million. 2020 JP Morgan admitted wrongdoing for market manipulation of silver to the US DOJ, $920 million, the largest fine in history, and they admitted wrongdoing. Scotiabank, $127.5 million, 2020 US DOJ, fraudulent and manipulative trading practices in the markets for silver. HSBC, $76.6 million, 2018 to 2023 CFTC enforcement for 2011 to 2020 spoofing. Deutsche Bank, $75.5 million, 2016 to 2021 silver fix settlement and CFTC actions for 1999 to 2014 rigging. Morgan Stanley, $1.5 million, 2019 CFTC civil penalty for 2013 to 2014 spoofing. 5 between 2008 to 2016, 5 of these major banks systematically manipulated precious metals markets through spoofing, price rigging, and benchmark manipulation. Regulators caught them. Fines and convictions spanned 2016 to 2025. Now here is the question you should be asking. If they did it for 8 years, got caught, paid fines, and traders went to prison, what makes you think they stopped? This was concrete evidence of market manipulation of silver historically that was swept under the rug. And it's possible markets are witnessing it again with the current silver crash of 2026. Let me show you exactly how they manipulate silver prices because most people do not understand the mechanics, and that ignorance is what allows it to continue. Spoofing involves entering and quickly canceling large orders to create a false impression of demand or supply. Through these spoof orders, the traders intentionally sent false signals of supply or demand designed to deceive market participants into executing against other orders they wanted filled. According to the order, in many instances, JP Morgan traders acted with the intent to manipulate market prices and ultimately did cause artificial prices. They place massive sell orders to create the illusion that everyone is selling. The price drops. Then they cancel the orders and buy at the lower price. Rinse and repeat for 8 years. But there is a second layer to this manipulation: the paper-to-physical ratio. One study describes a 350 to 1 paper-to-physical ratio in silver contracts. 350 paper ounces for every 1 real ounce. That means they are selling silver that does not exist. For every 1 ounce of physical silver in a vault, there are often hundreds of ounces of paper silver traded in the form of futures contracts. Because these paper contracts can be created out of thin air, big banks can sell massive amounts of short contracts to drive the price down. This isn't a conspiracy theory. It's documented in regulatory and criminal cases. Between 2016 and 2025, global banks, including JP Morgan, UBS, HSBC, and others, paid over $1.2 billion in spoofing-related fines. Now let me show you what happens when the price starts rising too fast and threatens their positions. On January 29, 2026, silver hit $121.67, an all-time high. Then it crashed 35% in a single day. Here is what triggered that crash. Silver's historic rally hit a wall this week when CME raised margin requirements to 15%, triggering forced liquidations and a 31% crash from its $121 all-time high. On Thursday through Friday, January 30th to 31st, 2026, silver futures crashed 31% intraday after hitting an all-time high of $121.67 per oz on Wednesday. The catalyst? CME Group increased margin requirements to 15% on COMEX silver futures. The kill switch. When the price of silver goes up too fast and threatens the big banks, the CME can hike these margins instantly. This acts as a kill switch, forcing smaller traders to sell their silver contracts immediately because they can't afford the new, higher deposit. You might ask, how is this legal? The CME is not a government agency. It is a for-profit corporation. Its clearing members are the very same bullion banks, JP Morgan, Goldman Sachs, that are currently short silver. The conflict: if a bank defaults, the CME is on the hook. Therefore, the CME's risk management is actually bank protection. They aren't a neutral referee. They are the bodyguards for the house. Under CME Rule 802 in Chapter 7, the board has the absolute right to change margin requirements at any time without notice. Without notice, they can change the rules in the middle of the game with no warning. And this is not the first time. In 2011, after silver ripped from roughly $18 to $49 post-GFC, CME raised margins 5 times in 2 weeks. Silver promptly halved as leveraged longs were flushed. Same playbook, over and over again. Now let me show you what happened during this crash that should make every investor sit up and pay attention. JP Morgan allegedly closing a huge silver short at the exact intraday bottom of the biggest silver crash in 44 years is the kind of detail that makes even veteran metals traders sit up a little straighter. When you add in the London Metal Exchange going dark, HSBC systems going offline, and a sudden, aggressive CME margin hike on the same day, the story stops looking like volatility and starts to look, many argue, like an allegedly engineered reset of the paper silver market. Let me walk you through the sequence of events. As silver began to roll over on Friday, the London Metal Exchange, one of the world's key venues for silver trading, had a pre-market glitch delaying the start of electronic trading, while HSBC, a major London Bullion Market Association participant, also reported systems down at the same time in Hong Kong. In parallel, CME Group's COMEX division hiked margin requirements on silver futures just as liquidity was thinning into the weekend, forcing highly leveraged traders to either wire in fresh collateral within hours or dump contracts into a falling market. Reuters pushed out a report claiming the U.S. was ending support for strategic metals. Now the Energy Department said it's false and deliberately misleading. Just think about that for a second. The government says this is deliberately misleading. A false news story. Exchanges going dark. Margin hikes. All at the same time. Just this week, a financial crisis erupted in the heart of the global silver trade in Rajkot, India, proving that the paper price is a lethal illusion. In Rajkot, 44 silver trading firms officially declared insolvency with liabilities close to $425 million. These were gamblers who bet on the bank's promises on silver. When the global physical demand surged and the CME pulled the kill switch, many were caught on the wrong side of the casino's margin hikes. These Indian companies held paper bets, not bars. When the casino moved the goalposts, they were wiped out in hours. 44 firms, $425 million in liabilities. Wiped out because the banks changed the rules mid-game. Now let me show you the proof that the paper price is a complete fiction. Physical silver hit $130 in Japan and UAE. COMEX spot sat at $72, an 80% premium, the biggest decoupling in precious metals history. An 80% premium. The paper market says silver is $72. The physical market says you have to pay $130 to actually get silver in your hand. A massive, unprecedented great divorce of 2026 has emerged between artificial New York paper prices and the physical reality in the East. Paper prices were pushed to $70 this week. Physical premiums in Shanghai hit $8 per ounce. Either the paper price is fake, or there's no actual silver backing those contracts. I'm betting on both. And here is what the vault data shows. The inventory drain. As of January 9th, 2026, COMEX registered inventories, silver available for delivery, have plummeted by over 70% since 2020. The exchange reported a single-day negative adjustment of 3,256,882 ounces in the registered category. As a result, total registered silver fell to 98,138,005 ounces. That level is below the closely watched 100 million ounce threshold. Below 100 million ounces, down 70% from 2020. The vaults are being drained. The February 2026 smoking gun. As of early February, 18.72 million ounces have been called for delivery from February open interest of 19.11 million ounces, a 98% delivery rate. This is not a functioning futures market where contracts typically roll forward. This is a physical allocation mechanism. 98% delivery rate. Nobody is rolling their contracts forward anymore. Everyone wants the actual metal. Now let me show you something extraordinary that happened during all of this chaos. Between June and October, JP Morgan reportedly sold off its entire 200 million ounce paper short position. This freed cash to acquire physical silver, leaving the bank long in both physical and paper silver for the first time ever. For the first time ever, JP Morgan was short silver for decades. Now they are long. JP Morgan is going long on silver and making history. The bank now holds over 750 million ounces of physical silver, the largest stockpile in the world. In just 6 weeks, it added 21 million ounces. That's a staggering move in a market already under pressure. 750 million ounces, the largest silver hoard in the world. They manipulated the price down for years, accumulated physical metal at suppressed prices, and now they are positioned for the price to rise. By unwinding this position entirely, leaving zero short contracts for the first time, JP Morgan has not only neutralized its role as a market antagonist, but also signaled profound bullish conviction. Translation: Jamie Dimon and his boys saw the writing on the wall. As silver trade reader Joe Lang explains, JP Morgan just cut bait. They cut the legs out from under the Wall Street banks that borrowed silver from them short. That's where JP Morgan is getting the huge amount of cash. JP Morgan abandoned the other banks. They let them hold the short positions while JP Morgan went long. Those other banks are now trapped. Now let me tell you what this all means for you. The cash-only failure. If the banks push the paper price to $60, but nobody is willing to sell a physical bar for less than $90, the COMEX is forced to declare cash settlement. This is the ultimate game over. It's the moment the world realizes the casino is empty, the pool will finally run dry, and the paper price becomes a total work of fiction. View this as the last exit for the banks. These margin hike market-induced crashes are actually their final attempt to buy back your silver before it goes to $100 plus. One day soon, this nasty great separation will become a permanent divorce. If you are holding physical silver, do not let the paper price scare you. The paper price is manipulated. The physical price is where the truth lives. The CME Group's decision to raise margins is a stark reminder that exchanges prioritize market integrity and clearinghouse safety over price discovery. The Great Reset of 2026 is not just about a change in margin requirements. It is about the transition of silver from a speculative financial asset to a critical industrial commodity. If you are holding paper silver, ETFs like SLV, understand who is on the other side of that trade. JP Morgan serves as SLV's primary custodian. Based on SLV holding reports, JP Morgan's custodial role involves several 100 million ounces, creating concentrated custody and potential conflicts given JP Morgan's own proprietary positions in silver markets. The fox is guarding the henhouse. JP Morgan holds your silver while also trading against you. Let me leave you with this. The order also finds that JPMS, a registered futures commission merchant, failed to identify, investigate, and stop the misconduct. The order states that despite numerous red flags, including internal surveillance alerts, inquiries from CME and the CFTC, and internal allegations, they knew. They had red flags, internal alerts. They kept doing it anyway. $1.3 billion in fines across 8 banks. 2 traders sent to federal prison. JP Morgan paid the largest fine in CFTC history, and they are still the biggest player in the silver market. The paper price crashed 35% in one day, while physical premiums exploded to 80% in some markets. Margin hikes hit exactly when the banks needed them. Exchanges went dark at the perfect moment. A false news story moved the market. Mark's conclusion is that silver price suppression is actively happening again, in plain sight, and that fines are treated as a cost of doing business. Despite the seriousness of these claims, there is currently no public regulatory finding that current price action constitutes illegal spoofing or fraud. No enforcement action, indictment, or settlement from the CFTC, DOJ, SEC, Federal Reserve, or CME Group has confirmed the existence of a new manipulation scheme as of early 2026. They have not been caught again yet, but the evidence is mounting. The patterns are identical, and the playbook has not changed. I showed you the proof. I showed you the screenshots. I showed you the CFTC records. I showed you the fine amounts. I showed you the conviction records. This is not conspiracy theory. This is documented history repeating itself. The question is not whether silver is manipulated. The question is whether you will position yourself knowing this information. Drop a comment telling me whether you think the manipulation continues or if the banks have reformed. I read every single comment. Subscribe if you have not already. Hit that notification bell because this story is far from over. I exposed the banks crashing silver. Here is the proof. And now you have seen it for yourself. This is AG Profit Hub because the real story is never on the surface. I will see you in the next one.